There are many factors that account for the diversity in accounting standards throughout the world. The primary difference in accounting systems comes from the rule of law in the different countries. For example, common law was established in the United Kingdom and spread throughout the world as it dominated the colonies and expanded the British Empire. Most Anglo-Saxon or English-speaking countries follow the common law approach. In common law countries, accounting standards are determined by a non-governmental agency. For example, the FASB sets accounting standards in the United States. This is in contrast to countries that follow code law, where most accounting standards are set by legislative bodies and are part of the legal framework in those countries. One of the major differences in how the accounting standards are set in these countries is that common law countries tend to be more specific. For example, you'll see specific bright lines, 75% as a cutoff for determining the classification of leases, versus code law where you'll see words like significant, which is left up to more interpretation by the end user. In code law country, financial statements are typically used as the basis for taxing as well, so the two are linked very closely together, which means that code law countries tend to be more conservative and paint a bleaker picture of their income than you would find in common law countries, where the financial statements are not the same as the tax returns that are sent to the IRS. So I can paint a very optimistic picture in my financial statements, while at the same time painting a very bleak, cloudy picture in my tax documents using the same set of numbers as a base. Accounting diversity also takes into account where our capital is coming from. In common law countries, a lot of capital is raised through stakeholders and with a lot of public companies. As these users invest money into these companies, they require greater transparency and accountability by the management of the companies. In countries where the financing comes from banks or private sources, there tends to be less transparency in the disclosure and operations of that business. Countries that follow code law typically fall into what is called the macro class of countries. This is also called Class B. Common law countries often fit in the micro class, also known as Class A. Finally, there are several countries in the Middle East that follow Sharia law. These countries follow Islamic financial accounting standards developed by the Institute of Chartered Accountants in Pakistan and comply with Islamic law. Worldwide accounting diversity creates several differences in the way that financial statements are prepared and presented for different countries. For example, in the United States, we have three major sets of financial statements found in the income statement, the balance sheet, and the statement of cash flows. In many countries, a cash flow statement is not required at all. In those financial statements, the presentation will vary from country to country as well. For example, on the balance sheet, American companies will typically list assets in ascending order of liquidity. So we start with cash, followed by accounts receivable, inventory, and then property, plant, and equipment. European countries will typically reverse this, starting with their fixed assets or illiquid assets, and then list them in reverse order of liquidity. Inventory, accounts receivable, and cash will be the last item in their assets section. The number of documents and disclosures that are also available will be different. For example, in IFRS, one document will have a very abbreviated list of accounts and balances, but then have several dozen pages going through all of the disclosures and listing all of the different notes explaining what those numbers come from. This requires investors to spend more time investigating what is actually in those notes rather than relying on the face value of the financial statements. There's vocabulary difference. Even when countries translate their financial statements into English to attract more investors, you'll see words like inventory for an American statement appear as stock in a British English statement. Stock on an American statement would show up as shares in a British statement. Sales revenue might show up as turnover. So there will be some differences in the way that the accounts are presented as well. A few final notes that you'll see. One is dealing with goodwill. In the United States, we do not amortize goodwill, but we may see sometimes that the value is impaired at specific points in time. Whereas in Japan, they will amortize goodwill over a maximum life of 20 years. Asset revaluation. In the US, we follow this lower of cost or market principle, which says that we can lower the price of our inventory, but we can never go back up. Whereas in Europe, The value of inventory and assets can change based on the market value, or the fair value of that asset. So we're able to mark those assets back up rather than just going straight down. Finally, in the United States, we do not adjust our accounts for inflation. We record things at historical cost, whereas Latin American countries may have to adjust because they experience high levels of inflation from year to year.